Welcome to Talk Tickers. So, AutoZone just dropped its latest earnings report, and whoa, the market's reaction was swift and pretty brutal. But the question is this headline panic telling the whole story? We're about to pop the hood and break down what's really going on.
Okay, let's just dive right into the number that set the tone for the entire day. A steep 7.1% drop in AutoZone's stock price. The earnings came out before the market even opened, and by the time that opening bell rang, the sell-off was already on.
In fact, this single-day plunge made AutoZone the worst-performing stock in the entire S&P 500. You saw trading volume basically double its daily average as investors were just scrambling to react. So, what exactly spooked everybody so badly?
Well, the sell-off was driven by what looked like a clear miss on expectations. But, as we're about to see, the headline numbers might not be telling the full story here. Let's unpack it.
The big shocker was the earnings per share. At $31.04, it missed what analysts were expecting by a pretty wide margin. And you know what's worse? This is the sixth consecutive quarter that they've missed on earnings. A one-off is one thing, but a pattern like that immediately sours the mood on Wall Street. Revenue also came in just a tiny bit light.
So, is that it? Case closed? Well, not according to management. They basically came out and argued that the market was fixating on a single accounting item, one that doesn't even involve cash, that was completely masking how healthy the business really is.
And that item is something called a LIFO charge. Now, LIFO stands for last in, first out. Just think of it like this. You've got a stack of car parts. When inflation is high, the newest parts you add to the top of the stack, the last in, are the most expensive. LIFO accounting says you have to sell from the top of that stack first, the first out. So your costs look higher, which makes your reported profit look lower, even if your business is humming along. And this quarter, that little accounting rule resulted in a massive, non-cash charge of $98 million.
And right here, you can see the huge difference that one thing makes. It's night and day. The headline number, the one everyone saw, shows earnings falling by almost 5%. But if you just strip out that LIFO accounting charge, the underlying profit actually grew by almost 9%. That tells a completely different story about the company's performance, doesn't it?
This was management's core message. They were trying to hammer home that demand is strong, their strategy's working, but these temporary things, the accounting noise and the fact that they're investing heavily in growth, are just clouding the picture of the company's real earnings power right now.
So if we do look past that accounting noise, we find the real growth story, because there is one part of AutoZone's business that isn't just strong, it is absolutely on fire.
I mean, just look at the difference here. The do-it-yourself side, their traditional retail customer, grew at a pretty modest 1.5%. But then you look at the commercial segment, we're talking sales to professional mechanics and repair shops, that grew by a staggering 14.5%. That's the engine of the whole company right now. And this didn't just happen by accident. Nope. This is the direct result of a multi-year strategy to go out and win over the professional market. They've been building out these giant mega hubs to have more parts on hand. They've been getting faster with deliveries, and it is clearly working. They're taking some serious market share from their competitors.
Now, that success in the commercial space is being fueled by a really aggressive investment strategy. And this is the other key factor that's putting some pressure on their short-term profits.
$1.6 billion. That is how much capital AutoZone plans to spend in fiscal 2026 alone. To put it simply, this company is in a full-blown expansion and investment cycle, and they are not being shy about it.
And here's the playbook for that spending. They're opening new stores at a near-record pace. They're building out that mega hub network to get parts even closer to their customers. They're beefing up the whole supply chain to support it all. And what's really impressive is that at the exact same time, they're still returning hundreds of millions of dollars to shareholders through stock buybacks.
This brings us to the crucial trade-off, right? In the short term, all this spending means higher operating expenses and, pressure on their margins. That's the pain. But the long-term bet, the gain, is that all this spending will build a much larger, more dominant, and ultimately way more profitable business in the next 4 to 5 years.
So, this brings us to our take on AutoZone. We are looking at a core conflict here. Do you believe the market's short-term pessimism, or do you buy into management's long-term optimism?
You really have two completely competing narratives. On one side, you've got management pointing to booming commercial sales and saying, hey, this accounting stuff is just temporary noise. But on the other side, you have a very skeptical market pointing to 6 straight earnings misses and saying, we see real margin pressure and we're concerned. So what's going to prove which story is right? Well, these are the key things we're going to be watching. First up, in the very next quarter, do those LIFO charges actually come down like management said they would? Then, later this year, can they keep sales growing even when the comparisons get tougher? And then, looking into next year, does that expense growth finally start to slow down as these big investments mature?
Okay, so based on everything we see right now, here's what we predict for the next 6 to 12 months. We expect sales growth to stay solid, but it's probably going to cool off from these really high levels. The reported earnings will absolutely continue to face headwinds from LIFO and all that investment spending, and because of that, we see the stock price likely just trading in a range, kind of treading water until the market gets clear proof that margins are finally starting to stabilize.
Given that whole dynamic, that balance between a really strong underlying business and some very real near-term pressures, our rating is market perform. This means we expect the stock to perform pretty much in line with the overall market. The long-term story is compelling, for sure, but that short-term uncertainty is just too significant to ignore right now.
And this leaves us with the final crucial question for any investor. Is the market correctly pricing in all the risks, or is this 7% drop a classic case of short-term panic creating a buying opportunity for anyone focused on the long-term growth story? That really is the billion-dollar question.
This is not financial advice.